it's going to take a heck of a soft number to really deliver momentum, more downside in terms of this yield. So suddenly the dual mandate will be the reason, the employment numbers will be the reason that we see the real possibility of a cut this year.
No, absolutely. You know, I like to kind of contextualize the current macro backdrop a little bit just to get a sense of how crucial this, jobs report is today. We've seen a slew of data this week, from PMI, ISMs, JOLTS, ADP.
Everything.
And we get central banks from, the other side of the pond starting to cut rates with the ECB, the BOC. But, the main event still is the jobs report today. And the reason being, there's just not enough, runway for the Fed here from an inflation perspective to get to target before the end of the year for these two cuts to materialize. So we're going to have to see a pretty significant deterioration of the jobs market for the Fed to move here. That is pretty clear.
But do you really see that? I mean, we're trying to run the numbers. I mean, they need a heck of a series of good numbers on the inflation side, on the disinflation side. On the jobs numbers, we've run some numbers. We're going to need to see jobs, unemployment at around 4 1/8 on a 3-month average before you would call the technicalities of a recession. Again, that's a pretty high bar, Frank.
Yeah, that's a pretty high bar. I think, the markets are looking, especially risk assets, are looking for a Goldilocks number about around 150K, more or less 10%. But anything below that, I think the threshold really for the Fed in terms of the bogey for the Fed to really start panicking and think about rate cuts here very rapidly between now and the end of the year is the 100K mark, right? And to your point about having to see a series of data before cutting, I totally agree with that. I mean, the Fed has been pretty adamant that they want to see a series of data. Same thing with inflation, right? We had three pretty hot prints early in the year, but the Fed didn't, just panic and start raising rates. So same thing with the jobs market, right? And if you think about the word series, mathematically speaking, you need at least 3 data points to be able to have a series, right? Because if I say to you 1 to complete the series, most people would say 3, but it could be 1 to 4, right?
Which would play to what Waller intimated in terms of wanting several more constructive inflation prints. Let's bring it back to the bond market. We rallied, we got 20 basis points. It's not what you call a furious rally, but it had momentum. You say cyclical positive convexity into a softening economy. I mean, my question to you is, what is it that breaks to the downside? What is it that you need to see in data to help the bond market break lower in yield?
I think it's going to have to be, like I said, major breakdown in labor market data.
And that's going to be around 100,000.
That's going to be 100,000 on the 3-month moving average.
ECB jacked up their inflation estimates for this year and for next year. Again, and at the end of the last show, we just heard from Christine Lagarde, where she talked about sticky inflation and she talked about a bumpy road. You have a tactical allocation to commodities because of this sticky inflation. Where exactly?
Well, the story of commodities now is slightly different. I think, the current macro backdrop still is favorable to an allocation for commodities, but I think investors need to make sure that they remain a little bit more nimble here and watch out for the different idiosyncrasies of commodities and the technicals around commodities. I think it's more of a story of being tactical and agile around some relative value plays, within the commodities complex, say, energy to metals RV plays, relative value that is. So we've seen recently, for instance, a lot of fund managers playing, copper against oil, right?
Yes.
So these are the types of plays that investors are going to have to, kind of be agile on instead of just having a beta allocations to commodities where we are in the cycle today. So I think it's more around finding, if you have a stock picker mind, it's more about picking stocks here than buying the index, so to speak. So you want to be tactical around copper, gold, oil, and be respectful of the technicals. I mean, we've seen what happened, to crude oil here recently, where the market basically got derated, because of a sequence of bearish catalysts, and we are today with the market that's kind of almost max short, versus copper that's overstretched to the long side. So these are technicals that investors need to be watching as they allocate.
Do you think those pivot points come when you see that overstretch on the bear side in oil to the overstretch of the bull side on copper? You sort of dig a bit deeper into the technicals and you look for pivots.
Correct.
Lisa Charlotte over at Morgan Stanley, I think it was a fairly straightforward analysis. The path of least resistance is to grind higher.
Yeah.
You look at, I mean, what was it I said? Microsoft, Nvidia, and Apple. The three stocks are bigger than the entire
Chinese stock market.
It's a pretty gargantuan statement.
Yeah.
You warn of complacency in the equity market. Now, the last time you were with us, you were warning, look, there's a possibility of a drawdown.
Yeah.
There's sort of nothing stopping the freight train of the Mag 7 at the moment.
Yeah.
But talk to me about what you are basically talking, this complacency. How complacent are we? How fully invested are we? And what is it that worries you so in terms of positioning?
Yeah, so what I'm worried about is, this momentum, to your point, is very strong. That's undeniable. But I think there's a risk of this momentum kind of peaking here a little bit. Positioning is very overstretched. CTAs are max long. Asset managers are almost fully invested. 150 basis points in cash. That's near. It's almost a 10-year low here in terms of cash allocation. So I feel like the only thing that's supporting this market really is the hefty amount of buybacks programs that are still very active in the marketplace. Mm-hmm. So I think the market is being very, very complacent. If you look at vol and skew on the S&P, for instance, that's really, really cheap. So I think investors should be looking at plays such as buying some cheap downside protection by buying some puts. Perhaps you have at the money volatility on the 3-month basis on the S&P that's sitting at a 12-year low, right? So even if you're long the market, I think it's a pretty cheap insurance to add to your portfolio at the moment.
We're going to hear from Keith. I know that you're going to set your clock. I know you're going to be logged into YouTube later on this evening. I know you're going to make the strategic, tactical investment advice based on Keith Gill appearing on YouTube. I'm saying that with an ironic smile, but actually we shouldn't be smiling because Amy Silverman was with me from RBC on Tuesday, and she said, do not decry what's going on with meme stocks, GameStop, AMC, she said, because it does have an impact. It does have a material impact for institutions. What are you and the rest of the team talking about as we're covering, there's GameStop, up 33% this morning, up 70-odd% over 2 days. I know these are violent small stock swings, but they have some kind of residual impact on psyche, don't they?
No, totally. And I think, if you look at a lot of people that are running risk today, say versus pre-pandemic, everybody has to have the ability to model these things, right? Because the investment psyche and behavior has changed a lot with sort of the gamification of investing. So we have to be respectful of that. There's still a wall of money out there that's sloshing around, that's going to continue to chase these type of opportunities with meme stocks. So
do you think it's just retail that's playing those stocks, or is there some kind of hint of institutional behind that as well?
Well, I think institutional players are looking for ways to exploit this market, right? But I think it's mainly retail driven, but you can't have a one-way market, right? It's got to be two players, and I think institutional investors are looking for ways to capitalize off of that.